Great to have you with us. We mentioned that today's trading could be influenced by NVIDIA. The AI chip darling is set to report its quarterly results after the bell. Obviously, the AI boom has helped tech stocks fuel the broader market this year, but the Canadian stock market actually comes into this trading day having closed at an all-time high. So let's bring in Lesley Marks, she's Chief Investment Officer of Equities at Mackenzie Investments, and great to see you.
Good to see you, John.
So I guess kind of two paths to talk about today. Big tech, but also this big rally for the Canadian stock market, which, you know, some of it is tech, some of it is banks, some of it is gold. What's your general thought on what's the mood of the markets right now, first off?
Well, it's interesting that one stock, NVIDIA, could have so much influence overall, to overall sentiment for the U.S. market.
Yeah.
I would say the equivalent here in Canada is the Canadian banking sector. I know that's not one stock, but it is a very important sector to Canada. And as we've seen over the last couple of days, Canadian bank reporting, on balance, has been pretty strong, actually very strong in some cases. For example, what we saw out of Royal this morning. So I think that is actually putting, an even more positive halo on the Canadian stock market, because the Canadian banks are very much representative of the Canadian economy because they have a very broad-based look into Canadians, but as well, many of our banks also operate in other areas of the world, particularly the U.S.
Yeah, and I guess, we always talk about how much money they're setting aside for potentially bad loans, and while they're always being prudent, I think that even versus some of the expectations, there seems to be a signaling there that they feel reasonably good about the state of affairs with their businesses right now.
That's right, and that's one broad-based trend that we saw across the Canadian banks that have reported thus far, is a reduction in provisions for credit losses. And so, in general, what that says is that the banks were more cautious over provisioning versus what they are experiencing, and that is allowing them to reduce those provisions on a look-forward basis. And so, again, a very good indication of both the Canadian economy and, in some cases, the U.S. economy.
So what would you be watching, given that we've seen these record highs for equities, as sort of the catalyst forward? Or is that even the wrong way to think about it, like this thing or this thing matters the most? But I guess we'll see if there's continued excitement with NVIDIA. We'll see what happens with things like interest rates or tariffs, or whether the quality of earnings that we just saw through most of earnings season holds up as we now move into the third quarter. So like what matters most to you at this point?
Well, it's so easy for investors to get caught up in the noise of the market, the news of the day. So I think your question is right. It's, what is the bigger picture that's really driving markets right now? And what's really driving equity markets is two trends. And the first is the earnings. Q2 earnings, granted, the bar became very low after Liberation Day in April, but Q2 earnings in general were a very large surprise, probably one of the largest surprises that we've seen in a while, where the expectations in aggregate for the S&P 500 was only about 6% earnings growth, and what we saw was a range of 9, 10, 11% earnings growth, depending on the source that you use. So we saw big upside in earnings. The second trend is the expectation that the Fed is going to restart its cutting cycle and start lowering interest rates again in September. So to your question, whether or not this is sustainable going forward, I think we have to understand what our view is on both of those factors. And I think based on how the economy is tracking, based on the strong momentum that we're seeing in demand, AI-related demand, which is driving a big part of S&P earnings, we expect to see a continuation in strong earnings. So then the second question is about the Federal Reserve. And as we've seen more recently, the focus is to find one way or another to get the Fed to continue to be dovish and even more dovish. Jerome Powell opened up the door to the rate cut for September last week in Jackson Hole. So both of those factors we think will actually continue to inform investors and continue to create that tailwind for equities going forward.
And something else we haven't been talking too much about in recent weeks, but like the big beautiful bill is probably going to give some tax flexibility to a lot of companies too. That's not like quality earnings, but that is still possibly some momentum as well. But I do wonder about, like, people ask the question about diversification or where your, what your portfolio looks like. And because there's been so much money that moved into tech and that has really influenced more so the U.S. market than the Canadian market, but like basically if you own the S&P, you own a lot of tech, right? I mean, how do you feel about that?
That's right. And now the S&P is extremely concentrated in technology. It's got the greatest exposure to technology compared to the major benchmarks around the world. So investors that are invested in the S&P, which has definitely been, the place to be for a long while, are overexposed to technology. Now, granted, technology has had the greatest earnings momentum. So the moves that we've seen in technology has been very much justified by the earnings that we've seen from these large companies, the Microsofts, the NVIDIAs, Netflix, Amazon, very strong earnings. So it has been justified. But you actually brought up a third factor, which is the one big beautiful bill and the importance that will have to companies more broadly when it comes to deductibility of capital spending or R&D spending, and that should have a broader impact on more companies. And so the expectation would be that you start to see a broadening out of markets. Over the last 5 or 6 years, we've seen this real spread between how the S&P, market cap weighted S&P has performed versus the equal weighted S&P. And that gap will start to close if we start to see a broadening out in market returns. And I do think that policies like the tax cuts will start to impact smaller companies, companies that pay higher tax rates disproportionately. And that's another positive for stocks.
Okay, so all in, you're still fairly constructive on equities, and you'd be suggesting to people, look at where you're exposed, and there might be, an opportunity to have a little bit more real exposure to the stock market as opposed to just the Mag 7 per se.
Exactly. I think if you look at, if you're only invested in the S&P 500, you're very much invested in the Mag 7. The top 10 stocks represent 40% of the S&P 500. So even looking internationally, you look at the fiscal spending that's happening in Europe. You look at the policy decisions that are even happening day by day here in Canada, and the view towards further developing our resources. I mean, gold has been a big driver of the TSX, but I think going forward, the driver of the TSX in the materials sector could be, in addition to gold, base metals as well. We have so much opportunity here in Canada, and so there is more opportunity than just going with the biggest names that have really been the key drivers over the last 3 years.
All right, great perspective, Lesley. Thanks very much. Good to see you.
Thank you.
Lesley Marks joining us from Mackenzie Investments.